Greetings, my name is Kevin Matthews and I am the tax professor. Remember, class is still in session because the learning never stops. So what we want to talk a little bit about today is capital gains and losses. I get these questions, and capital gains and losses seems kind of like a basic topic, so to speak. But for the most part, you probably need to understand that there's still a lot of questions that people oftentimes have about capital gains and losses. We're going to do this at the 30,000 level. We're not really going to get into the detail in the weeds too much. We will a little bit, but only as much as a nerd like me would feel comfortable with. So what we're going to do is we're going to first of all talk about different types of rates. When we're talking about capital gains and losses, we're not talking about things that are treated like capital gains and losses. Obviously, there's a lot of things that are treated like capital gains and losses. For example, 1231 gains or dividends that you receive. But for the most part, we're not talking about that. We're talking about different rates that happen for different types of capital gains and losses that happen. Before we go into that, though, I think something that we want to talk about is what causes capital gains or capital losses. And it's basically selling what the IRS determines to be a capital asset. All right? So if you're selling an asset that is determined to be a capital asset, and it's generally anything that, in a business would be depreciable property. Okay? So, for example, you buy a house. That's a capital asset. You buy a car. Capital asset. You buy land, capital asset. You want to buy, one of those standing lawnmowers that you can use in order to mow lawns of acres and acres of land. That's actually a capital asset. Drill that costs, a couple $1,000, capital asset. Okay, now oftentimes it's not as much cost that really gets us into this, but the fact that it's an asset, it's something that could be used for more than a year, is generally how a capital asset is defined under accounting rules. And there's certain exceptions that the IRS basically says that's not going to be considered a capital asset. And the big question that we've always asked ourselves is, what is a capital asset? And actually, I remember I came into this field back in 2012, and they were still trying to wrestle with this question at that time. And it really wasn't until the universal capitalization rules got adopted that we're now able to say, okay, if it's one of these, it's a capital asset. If it's not, it's kind of not. And it's always facts and circumstances. And then there's also some things where we say there's de minimis. So for example, I have a hammer. Obviously, I'm not going to use a hammer for only, 6 months or 9 months. I mean, I still have a hammer that I bought when I first got out of college, over 20 years ago. So the hammer, but the hammer cost me, $10? I'm not going to call that a capital asset. And the reason why we're not is because the amount of money it has is just so small. Okay, so we're not really going to be focusing on that as a capital asset. And so the IRS has said, look, if you spend under a certain amount of money, it's not considered a capital asset. Now, are there personal capital assets? Yes. Are there business capital assets? Yes. And obviously they're handled differently, and we may talk a little bit about some of those as we go along. Getting back to the rates. So we want to talk about the rates. There's a 28% rate, there's a 25% rate, and then there's the 2015 and 0% rate. Most capital gains are going to fall within the 2015 and 0% rate. Now, why is it 2015 0%? It depends on the income bracket that you file your ordinary income in. So if you're a very low income earner, and maybe you're in the 10 or the 12% bracket, you're only going to pay 0%. You're going to pay 0% on your capital gains taxes. Now, that means that if you're, and generally the only time I've ever seen this happen is when people are retired, or if they have a business that has severe losses. It's very rare that I see a whole lot of clients who do that, but that's mostly because as a CPA, nobody's going to hire me unless they got money. So that's just the way things are. The majority of Americans are going to pay at the 15% capital gains rate. Now, what that means is, if you sell a bond, and you bought it for $10, you sold it for $20. Bonds are, capital assets also. You're going to have capital gains on that bond of $10. So if you sold it for $20, you bought it for $10. Delta between the two is $10. That's going to be your capital gain. Now, if you are in the other tax brackets other than the 10 to 12 and the highest one, you're going to pay 15% capital gains tax on it. Much better than if you paid ordinary rates, which could be as high as 37%. Now, if you're in the max tax rate, you will pay a capital gains rate of 20%. Now, aside from that, there's also this thing called the net investment income tax. We haven't talked about that yet, but we will later on in another video. So I'm going to hold off that discussion for later on. But that's separate from that 15, 0, and 20%. Now we have what's called the 25% group. And the 25% group is always going to be unrecaptured Section 1250 gain. That is, when you sell rental real property and you've depreciated the property, there's going to be a certain amount of the gain that's attributed to that. That is going to be taxed at 25%. If you're not selling rental real estate, probably don't have to worry about it. Or if you're not selling real estate that's used in a business, don't have to worry about it. I would say most people never ever talk about it. We CPAs talk about it all the time because we're always dealing with people who are selling rental properties all the time. So the 28% group, however, we call this the collectible rate, and it's because mostly it's on collectibles. Works of art, rug, antiques, metals, gems, stamps, coins, and alcoholic beverages. Yes, folks, if you sell that nice bottle of Jim Beam that you got all the way back in 19 whatever, and you sell it later on at a massive gain, you have to pay tax on it. All right. There's also the 28% rate also applies to Section 1202 gains, but we're not gonna get too much into that because Section 1202 small business stock, that's just a complicated conversation. All right. So how do capital gains work? Capital gains are very simply, they do the way it works and calculating the capital gains is that you take all of your capital losses, your capital gains. There's a netting process that they go through that you end up reaching at the bottom, which says what your overall capital gain is and what the character of it is. So you have, and you might ask me, what's character? What do you mean character? Character means whether it's going to be a short-term capital gain or if it's a long-term capital gain. Okay, short-term capital gain is a year or less. Long-term capital gain is more than a year. In other words, a year plus 1 day. So you want to make sure that you completely understand that. And if you do get the long-term capital gains, that's where you're going to be paying all the rates that we've talked about up above. If they're short-term capital gains, you're always going to pay your own marginal ordinary rate. And that's going to be whatever your tax rate is. Talk to your CPA, EA, or tax attorney about what that rate is so that you can get a better handle on what that is. Okay? But again, we do the nettings. So we net short-term, long-term gains. We net short-term gains and losses, long-term gains and losses, arrive at an overall gain and loss. If it's a gain, it's taxed. If it's a loss, what happens? That's a good question. So if you have a loss, that loss is going to be allowed to be used against your income only up to $3,000 unless you're filing married, filing separate, which you're only going to get $1,500. So we have to make sure that you're, keeping up with that. But again, you definitely want to make sure that you are understanding that you can take up to $3,000 a year against your income. And so it can be a tidy bit of savings, but it's not much savings, but it is some savings. There are some alternative minimum tax hits. I'm not going to talk too much about those for two reasons. Number one, we're going to do an alternative minimum tax video later on. The second reason why is because when I start talking about AMT, it's going to blow this video up, and I've already gone way longer than I should have. All right, folks, that's all I got to say about capital gains and losses. My name is Kevin Matthews, and I am the tax professor. Remember, class is still in session because the learning never stops. If you want to reach out to me, you can leave a comment in the comment box below. Or if you want to just ask a general question, go ahead and leave it in the comment box below. Or if you'd like to, you can go ahead and go to my website at www.betasolutionscpa.com. Again, that's www.betasolutionscpa.com. And I'd be happy to talk to you about whatever questions that you have about this or any other video. Again, if you guys have liked this video, please go ahead and hit the like button. If you really like this video and you want to learn more, go ahead and hit the subscribe, and as videos are coming out, we'll go ahead and get those notifications out to you so that you can learn, and keep up with that learning, because remember, it's never going to end, folks. It's not going to end until they bury me 6 feet into the ground, and that's when the learning stops. Okay, so thank you very much for watching this video.